Did the Fed just get rugged? And are they about to rug the entire market after the upcoming CPI data release? Hello and welcome back. Markets looking stable this morning after some rocky times yesterday. I actually added into my Bitcoin longs for the first time in over a week, not least because of the turnaround in gold. So we're going to get into that in just a second. But that being said, breaking news today does bring into question the validity of the CPI data report that we're due to have on Friday. We are currently trading at $107,657. We did continue some of yesterday's down move into liquidity here, into this really tight range that we put in on the 18th of October. And with that move, I added into my Bitcoin long. So we are now 0.9 BTC in this position, 20x leverage. We are down $5,347, and adding into that position, averaging into that position, has brought my average price down to $113,739. So my break-even price now is up here at $113,739, which brings it rather neatly just under the high that we put in yesterday. You can see here the ghost of that buy order that I put in, and look at this. Look how accurate we were with that bid. Okay, I placed that bid at $106,743, and the lowest we came yesterday was $106,679. So we just got it. I'm pretty pleased with that. Almost hit it on the first wick, but that was just a resting order, a limit order that I left in the book, and we got it on the second wick, averaging my price down. That somewhat reduces the risk of this position, okay, because the average price is now lower, although the position size is bigger, and the estimated liquidation price for this now is $101,346. As I've said in the past, I don't mind adding more capital to this account to keep it afloat, because we don't want to end up like the $100 million worth of long liquidations that we saw just over the last 4 hours, or worse still, the $371 million worth of long positions that we saw wrecked, liquidated, wiped out over the last 24 hours. Still happening, as I've said time and again, keep banging this drum. People keep jumping in on leverage in this market at the smallest sign of green shoots. I think what is interesting though, at the 4 hour time frame of these most recent liquidations, is the price hasn't been that ridiculously volatile. We're not actually moving that much within this range. So I think that points me towards the market potentially becoming a little bit confused. And once again, I mentioned this a lot as well, my theory that the loops of this liquidation cycle of everyone jumping in long when the market goes up a little bit, then getting liquidated, then the market goes down, everyone gets shorts, gets liquidated when the market comes up a little bit. My theory is that these cycles of liquidation risk are tightening and getting smaller and smaller as retail runs out of steam, runs out of motivation, runs out of money that they can borrow against to get long into this market. You can see fear and greed. We are down from yesterday just a little bit. I think we were at 31 yesterday out of 100. We're now at 29. Either way, the market is in fear. The market is running out of motivation. And just at the point when they do, I believe, is the point when we can come back up again. Also, take a look at this gold correlation. So gold is down still from yesterday, 6%. We were down as low as 8% on gold. That is, just to put into context for you, what a staggering down move in gold that is. We haven't seen a move like that in the market, a single day sell-off like that, since, I believe it was June 2013. Okay, gold does not move like that. Gold is not that volatile. A lot of people have been exiting gold. Look at that, down 8%, over 8% on the day. And what do we know about what happens when gold turns around? Well, historically, at least the last two times that gold has gone from being in an uptrend, i.e. prices on average going up, to being in a downtrend, i.e. prices on average going down, both of those times historically, starting here on the 3rd of November 2024 and here on the 8th of May 2025, depending on exactly where you measure it from, that has resulted in a massive rally in Bitcoin. To put a specific number on it, the first time that was worth about 62% to the highs, and the second time that was worth about 33.91% to the highs. Both massive rallies in Bitcoin, both came in just at the point at which gold turned around, and it looks very much like gold has just turned around. Take a look at the liquidation map. We are stacked to the upside. As we extend this to the 30-day time horizon, every time we don't make a massive breakout, every day that goes by, in my opinion, that we don't make a massive breakout to the all-time highs on Bitcoin, more people trickle into the short, and you can see this building up. Okay, there's now $5.25 billion worth of short liquidation risk to the upside. People betting on the market going down. If the market does start to come up, these positions will start to become liquidated. That means they will be forced to buy onto the market. If a short position becomes liquidated, they are forced to buy, and that causes a sudden increase in demand on the market. And when demand goes up, prices go up. But there is always a but. I don't necessarily think we're out of the woods yet. The market has been excited about the macro picture. They've been excited about further dovish moves from the Fed. Unfortunately, some of that is coming into question. So yesterday, I think we were looking at something like a 98% chance of a further 25 basis point rate cut at the next FOMC meeting. That is now down to 96.7%. Quick refresher, rate cuts, good for Bitcoin because they mean money becomes cheaper. They mean that liquidity is traditionally injected into the market, into risk assets, into crypto, into Bitcoin as well. But some of this is coming into question. So look at this. This week's critical inflation report comes with a variety of doubts about the data. The September Consumer Price Index report, that is CPI to you and I, coming out Friday, will command full attention from financial markets, even as some investors will view the data with a skeptical eye. The Bureau of Labor Statistics, the BLS, has been criticized for its analog approach. If we see CPI come in worse than expected, i.e. inflation is hotter or worse than expected, it is more likely that we see hawkish Fed movements going into the future. Okay, that is, i.e. not further rate cuts, not more liquidity coming into risk assets. But look at some of the reasons for this. With the BLS already under scrutiny this year for its broad menu of data releases, the government shutdown gripping Washington, D.C. will only raise concerns from parts of Wall Street about whether the inflation reading will represent a full picture. Skeptics like me are going to be focused on how clean is this data, said Vishal Kaduja, head of the broad markets fixed income at Morgan Stanley Investment Management. What were the accommodations made for the lack of full personnel staff showing up? What adjustments were made before the data got reported? And the second part of this, which is why I said it looks like the Fed has been rugged, is they were also relying on supporting data from ADB. But they have just lost access to that weekly data. Federal Reserve is said to lose access to ADP private employment data. Now, this isn't used directly for CPI, but it is used for their projections of inflation, and thus comes back to whether or not we're likely to see further rate cuts and further injections of liquidity into the market. Payroll services company ADP Research stopped providing data on private sector employment to the Federal Reserve, adding to the lack of economic data that has resulted from a 3-week-old government shutdown. The Federal Reserve uses private economic data to complement the US government reports, which Fed Chair Jerome Powell has described as the gold standard of economic data. Labor market data is crucial for the central bank to discern how well it's doing in achieving its dual mandates of full employment and price stability. The reason for the cutoff wasn't immediately clear, and the ADP and the Fed declined to comment to the American Prospect, which first reported the news. So also somewhat suspicious circumstances surrounding this. And on top of all of that, we are still waiting to see at the end of the month resolution on the US-China trade deal. All of that in summary, we will see data released on Friday for CPI, and we will see how the Fed takes that, how the market takes that. I am very bullish on this gold correlation, okay? It doesn't necessarily have to come to fruition again, but although history doesn't tend to repeat itself, it does tend to rhyme. And once again, both times we've seen gold turn around, we have seen the trickle of liquidity into the Bitcoin markets, and we've seen massive rallies in Bitcoin, and gold has turned around in a way that we haven't seen since 2013. On top of that, this liquidation playbook that we keep seeing is repeating itself, the loops are tightening, and short side liquidation risk is stacking higher and higher and higher to the upside, meaning any turnaround that we could see could be massively extended to the upside. That's why I'm happy adding into my long position even though we're underwater, and that is why I will happily keep adding capital to this account if I need to act on further buying opportunities to the downside. As always, that is purely my opinion, just shared for entertainment purposes. Nothing I say should be considered financial advice. But thank you so much for watching. There is plenty more to come. Catch you in the next one. Bye.